ORR, high-tech city. These are some of the best sub-markets within those markets, right? So the key differentiator, I think, for our portfolio is locations. And I keep saying this, it's a cliched sort of real estate comment about location, location, location. But it's really true that if you have well-located assets, they generally perform much better, and also sort of undergo downturns much better when you have better locations, right? And that's what I think KRT represents. We also have uniquely 29% of our portfolio dedicated to what we call front office tenants or city-centric locations, right? Again, a unique factor where tenants, which provides us diversity not just from tech and GCC oriented tenants, but also provides space for the KPMGs and the consultancy firms and the law firms, the banks, etc. So it's a different base of tenants, and as India grows, economically, the front office is experiencing a lot of demand as well. So the tailwinds of both the GCC flow as well as the front office, thanks to the economy, continue to support our portfolio, and we're very excited about that. If you can see on the right, there's a lot of performance metrics. 91% occupancy, a WALE of 8.5 years, which is obviously quite long. A real opportunity to mark our rents to market of 23%. What that means is that we've got current rents in our portfolio which are significantly below where market rents are, giving opportunity for those rents to go to market and therefore get appreciation in the performance of our portfolio. And then leverage, which is very low, right? So post the IPO, our leverage is going to be 19%, which is the lowest in the sector. And it's intentional because all the proceeds we are raising are actually going to pay down debt, and that creates an opportunity for us to use this dry powder to make acquisitions. So as we move forward, we will be looking to make acquisitions and grow this portfolio. As Mr. Agarwal pointed out, intentionally we have a brand agnostic platform. Knowledge Realty Trust is obviously not aligned to any particular developer name. We are intentionally brand neutral. The idea is to use that neutrality to reach out to maybe non-strategic owners of real estate who want to maintain a local brand, but yet want to be part of the REIT world. And so this is the opportunity we hope to provide to a lot of people out there, where they can maintain their local brand, but yet have the assets owned by us, managed by us, and in exchange they get units in the trust, right? We also have the low leverage, so we can sort of use cash as well as units to make acquisitions going forward. So that's the portfolio. I think you saw some of the assets, but I just wanted to describe briefly and give you a sense for the quality of the assets. Here's the high-tech city portfolio in Hyderabad. What started as one asset in 2016 has mushroomed into 10.5 million square feet here in Knowledge Park and Knowledge City, which are in the high-tech market. And then you've got the Knowledge Capital asset, which is a 100% leased asset to Google. Gives you a sense for the quality, the tenancy, the F&B that we have here is outstanding, and it's really become a destination in Hyderabad. And we're very excited to have this portfolio serve as a jewel in our crown as we move forward. The Mumbai assets, I think most of you are probably quite familiar. Top right is the one BKC asset, obviously preeminent address in the BKC market in Mumbai. In Lower Parel, we've got these three, erstwhile ex-India Bulls assets, which we have renamed, and one International Place, one World Center, one Unity Center. Very recapitalized and repositioned assets in the Mumbai market, dominant in Lower Parel, very exciting. And then the bottom right is an asset which is in Powai, which we had acquired from L&T. So that's the Mumbai portfolio. Moving on is the Bangalore portfolio, which mostly is on ORR and has great tenancy like Cisco and others in this portfolio. We've got Amazon, which has Satva Horizons asset there in the middle, top middle, and on the right we have a trade center asset which is in Bangalore CBD. As you can see, that has sort of a prestige name that you can see on it, and that's intentional. This was about the brand neutrality that we allowed, or the plan is to allow local developers to use their brand names, keep their presence, and yet the asset is sort of part of our portfolio. And that's just an example of hopefully others as we go forward and make such acquisitions. Moving on, sponsors, I think you've heard, and Blackstone, I think most of you are aware, Fourth REIT, etc., very successful. But I think Satwa is really the story here. And I think, in 3 decades, Mr. Agarwal's leadership has really taken this company to a very different level. The amount of, square footage that they've developed, the amount that they're going to do going forward, although starting in Bangalore, now going to spread all over the country. And, all this with very low leverage and an excellent financial track record, right? So we're very excited to have senior management from both Blackstone as well as Satwa on our board. And that vision and leadership will help us as we move forward. One last point I wanted to make here was this whole concept of global capability centers. And I think you've heard this story before. And the point to note is that India is no longer just an outsourcing center, right? We are not a KPO market anymore. We have really moved on. And the skills, the high skills that we provide is what, the foreign companies are after. And if you look at this, chart, some of this will sort of explain that the high value added jobs in research and design, that's what's really leading the opportunity, right? And that's what we have in our portfolio. As Kaiser will explain as we move forward, those are the types of tenants we have and not the ITES tenants, which are obviously important for India as well, but our portfolio consists more of the GCC type of tenant. And they're coming not just from the US, right? They're coming from the US, they're coming from Europe, they're coming from Asia, and the numbers are growing. The number of GCCs being opened in India is really growing up every year. So we're very excited to have the tailwinds of the GCC growth, secular growth as I look at it, and the front office demand thanks to how India is performing. With that, I'm going to turn it over to Kaiser, and he's going to walk you through our portfolio and give you a little bit more detail.
Thank you, Suresh. Just on the note of secular and structural sort of demand which is happening, let me just take a step back and give you a little bit of a story on what's happening in the Indian office sector. So 2024 was the 2024 was in some ways the sort of the most active market for India in terms of the Indian office spaces. 79 million square foot got absorbed, and that's roughly about 16% year on year, and that's a record. The reason why I'm mentioning this, exactly a segue from where Suresh left, is why is this important? Because GCCs are doubling down in India, and domestic companies, by virtue of the buoyancy in the Indian economy, are deepening their footprint. And what's even more sort of really clear as a characteristic is the whole story from cost. It has moved to the capability arbitrage in India, and that's where the transition and the transformation of the Indian office is. And in the heart of all of this transformation, we believe KRT lies, and KRT is most well positioned to take care of this transformation. And that's when we are the largest REIT, both in terms of NOI and in terms of the value. As Ashish mentioned, 46 million square foot. That's our total portfolio spread over 29 assets, 6 cities. We're truly diversified. But what's again the characteristic? We're concentrated for stability in the top 3 office markets of the country, and that's Hyderabad, Bangalore, and Mumbai. Something very sort of important about this portfolio is this 46 million square foot is almost rare and almost impossible to replicate combination of 2 types of assets. One very large infrastructure kind of assets, which is in Hyderabad, the whole Knowledge City, Knowledge Park cluster. And then you have city center icons like the One BKC, the One World in Crore, and so on. So that combination of assets as big as 7.5 million square foot to 1.5 million square foot of city center icons in Mumbai is something which is absolutely unparalleled. But even more important is what we are doing on our operating metrics. We are the REIT, which is distinguished and clear lines of difference on a couple of points. Number one, we have the highest occupancy of 91%. As the fellow panel members mentioned, we're the only REIT, unlike our peers, to have the largest city center portfolio of 5.5 million square foot across Mumbai and Bangalore. Last but not the least, and even more, we have the lowest SEZ exposure. What you see is 14% really translates to only 2 SEZs. And those 2 SEZs have roughly 90% occupancy with a WALE of 15 years. And that's how well insulated we are on the whole SEZ side. So size and scale matters, but even more important is who occupies this office, because they tell an even bigger story. And the story is 450 occupiers spread over 20 diverse sectors. Essentially, what we want to say is that 45% of our rents come from GCCs. Not a single occupier contribute more than 6% to our gross rents. Essentially, we are not dependent on any single occupier for our performance. In addition to that, how are we talking about growth? We have fundamentally 4 levers of growth. Number 1 is mark to market. Our current leases are below the market rents. Number 2, leasing of the vacant area. That sort of adds to our NOI. Number 3, 9.2 million square foot of development, on-campus development pipeline to take care of incremental demand. And number 4 is the 7 million square foot of ROFO assets coming from the sponsors. Add all of that together with the low leverage of 19%, we have significant headroom to fund acquisition. What it really means is that you have 4 levers of growth, but fundamentally all of them are very low risk and almost secured in the bank. And that sort of leads to how our growth looks like in the next 4 years. Our NOI CAGR is 13%, so it essentially moves from 3,400 crore to 5,500 crores over 4 years. And that 13% CAGR, 82% of that NOI growth is secured through contractual escalations, rent premiums, rent resets, and leasing of the small vacant area. More importantly, what you see is a massive structural tailwind in our business, and that's a mark-to-market opportunity. Unlike any of our listed peers, we have 23% mark-to-market opportunity, which basically means at every time a renewal comes in, that's an opportunity for a natural uplift in our rents. To meet the incremental demand, 9.2 million square foot of development potential, 1.2 million square foot is expected to be completed by Q1 2026. And then 7 million square foot of ROFO assets coming from our sponsors. Add that to a brand agnostic platform and a 19% leverage. We are by far the most well-positioned REIT to pursue third-party opportunities. And that's a little bit of a financial snapshot of how we are thinking about our NOI growth and NDCF. Our NOI is growing by 13% from 4,700 to 5,500, which is a 13% growth over the next 4 years. But more important is our NOI margin, which is 90%, which is one of the most efficient in the listed space. What's also very important characteristic is about our structure. It's a very clean structure. Unlike previous past in other sort of listed spaces and listed players, we have no zero coupon, no rent guarantees, no working capital. It's an absolutely clean structure. It's a clean structure from NOI to NDCF. 13% NOI CAGR leads to a 9% NDCF. And that's what the investor gets. The strength of our cash flow gets distributed. 70% of our distribution comes in the form of dividends, which is tax-free. Add debt to it, which becomes 85%, either becomes tax-free or tax-deferred. We have, in addition to that, we've also been relatively conservative in our sort of interest rate estimate approach. There is enough buffers left within our cash flows that should the interest rate sort of go further down, that will have a direct bottom line impact on our NDCF. And just to sort of wrap this up, the IPO structure is essentially 6,200 crore. We did a pre-IPO HNI funding of 1,400 crore that left us with 4,800 crore. 4,800 crore is further divided in strategic investors, 1,200 crore. 3,600 crore is left for what the pool is out of the 2,700 crore is essentially for institutions, and that leaves roughly about 900 crores for the retail and the HNI
piece. To wrap it up, I would say KRT is the most diversified Indian REIT. But the story is not about the yield. The story is about the growth because the structural demand for office spaces in India and the quality of the offering and the quality of the asset we have to offer. Thank you so much.
Thank you, Kaiser. Quick announcement for the media journalists on the webinar. Please do type in your questions, comments. I shall address each one of them in this forum. We are open to the media questions here as well. So I would just request journalists to please introduce themselves and their publications.